It's been a mixed bag for United Spirits during Q2. On the top line front, they have actually done better than expected, delivering net sales, that's after deducting excise duty, at roughly about 2,146 crore rupees. So that's a degrowth of just 6 to 7 odd percent. Even lower if we remove that impact of, the one-off benefit of bulk Scotch sales that we saw in the last year or in the corresponding quarter. But it's on the margin front really where United Spirits has faltered. The EBITDA margins have come in at 11.2%. We were expecting a figure of 13%. The profit after tax has come in at 130 crore rupees. Rather, that was the expectation. The actual profit has come in at roughly about 128 crore rupees. So I would say more or less in line with expectation. Interestingly, the prestige and above segment has actually done better compared to what we were expecting. We were expecting the sales decline to be a bit more stronger over there, but it has declined. It's actually grown by 1%. It's the popular segment where the net sales has fallen in double digit versus last year. Priority states have seen a decline of 10%. Plus, there was also the increased consumer prices which impacted demand in this price conscious segment since it is a regular segment. The EBITDA, of course, like I mentioned, was significantly lower. Margins were down because of a higher advertisement and promotion investment rate to support the national, rollout of two of their core brands. That's McDowell's No. 1 whiskey and Royal Challengers whiskey. There was also lower fixed cost absorption. There was an inventory provisioning though, and if you remove the impact of that, then the EBITDA margin was 14.5%. So all in all, on the top line, not that bad. We've removed the impact of the one-off benefit of bulk Scotch sales as well last year, and still it's not so bad. It's on the margin front where they have faltered. But however, according to the company, if they remove the whole impact with respect to the inventory bit, then over there as well, the margins are not so bad. 14.5%. Anand Kripalu, the CEO, has commented saying that the agility of our supply chain team provided a faster start post the lockdown and in the renovation as well of the two core brands. The A&P reinvestment, by the way, increased to 8.6% versus 5 odd percent. So it's a conscious choice taken by the company really. And yes, they have that raising the bar bit as well. I'm not sure if there's any provision with respect to that or any expense ahead of that. But yeah, on the commentary, as always, United Spirits has said that they remain cautiously optimistic with the gradual reopening of on-premise and, of course, the ensuing festival season. And, you have to recognize the safety norms as well compared to previous years. And thus, they have said that they won't be able to give a qualitative guidance for the rest of the fiscal year 2021 rather. So they will sort of navigate the waters as and when they come through. But yeah, for now, it's a complete mixed bag from United Spirits.